Take two 65-year-olds near retirement. One spent 3 decades earning 6 figures, but lies awake wondering if he can afford to stop working. The other spent those same years pushing a broom, yet he's walking away with a multi-million-dollar net worth. Most people assume a large salary naturally leads to large savings. We've been conditioned to treat high earning power as a shortcut to financial success. But look at the behavior of the average earner. As the income line rises with every raise and bonus, the spending line follows it almost perfectly. This is lifestyle inflation, a behavioral trap where your expenses expand to swallow every new dollar you make. Income is just cash flow. It's the fuel, not the destination. Real wealth is measured strictly by the capital you manage to keep. For Robert Miller, wealth building happened in the most unlikely of places, the hallways of a local brick elementary school. Robert spent his days in a blue janitorial uniform, performing manual labor for a salary that was a tiny fraction of a corporate executive's paycheck. His life was defined by extreme, quiet frugality. He brought a handwritten brown paper lunch bag to work every single day, driving a rusted car and refusing to spend on modern conveniences. This created constant social friction. His coworkers, many of whom earned double his salary, mocked his lifestyle and pressured him to buy the things that would make him look successful. Robert faced a difficult psychological choice. He could perform wealth for his peers today by spending his paycheck, or ignore the ridicule to build actual financial security for the future. Robert chose the second path by following one simple rule: invest first and spend whatever is left. He removed human error through automation. Every time a paycheck was issued, a portion was diverted into an investment account before the money ever touched his checking account. This created an artificial scarcity. By never seeing the money in his primary account, Robert made it impossible for himself to spend it on a whim. He funneled these automated contributions into broad market index funds, essentially owning a small piece of the entire economy. Relying on willpower to save is a losing game for most people. Systematic automation turns a modest salary into an emotionless wealth-building machine. To see how this plays out over a decade, let's look at Robert's path versus a high-earning coworker. The coworker uses their high income to purchase status. They spend heavily on luxury clothing and designer suits to signal their high-earner status. They eventually take on debt to finance major liabilities, like a high-end Mercedes-Benz. It looks like wealth, but it's an asset that loses value every day it sits in the driveway. Robert, meanwhile, is buying assets. His index funds represent ownership in profitable companies that grow in value and pay him for their participation. Every time those stocks paid a dividend, Robert's system automatically reinvested the cash to buy more shares. This created a loop where his assets were constantly buying even more assets. This is the core difference between the two lifestyles. Liabilities require you to work to pay for them, while assets work to pay you. This strategy eventually faced the ultimate test, a catastrophic market crash that sent portfolios worldwide into a freefall. The high-earning coworker, seeing their paper losses, panicked and sold their remaining assets at the bottom. To maintain their lifestyle, they turned to high-interest credit cards, compounding their financial trouble. Robert ignored the headlines and the mockery. Because his system was automated, he continued buying index funds at a massive discount while everyone else was fleeing the market. Volatility only poses a risk to those forced to sell. For an investor with a 30-year horizon, a market panic simply offers assets at a deep discount. 30 years into his career, the quiet discipline of Robert's early days finally began to yield its massive payoff. Look at the shape of this growth. For 2 decades, the line is flat. But as compound interest takes hold, it accelerates into a vertical spike. The interest earned on his previous interest was generating more wealth every year than his janitorial salary ever could. Building wealth is a function of time. The number of years your money stays invested is far more important than the size of your initial paycheck. On his final day of work, the two paths reached their logical conclusion. The high earners, despite decades of 6-figure salaries, were trapped. Their lifestyle required so much cash that they couldn't afford to retire, tethered to their jobs by the very things they bought to look rich. Robert Miller, the man who was mocked for his lunch bag and his old car, walked out the door a multi-millionaire with total control over his time. True wealth exists in the invisible, the unspent capital compounding in the background, far more significant than any luxury car or high-end suit. Financial freedom isn't a privilege for the elite. It is a mathematical certainty for anyone willing to choose discipline, embrace delay, and let time do the heavy lifting.